Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Draganfly.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For anyone tracking Draganfly, the whole narrative has really shifted this year.
Right.
Kind of moving away from that typical, early stage drone company talk.
Yeah, the speculative stuff.
Exactly. We're focusing on something much more powerful now, which is this accelerating top-line momentum, and it's being driven by a real structural change in the business.
And that's the key, isn't it? It's not just growth. It's the rate of growth speeding up.
Precisely. If we just look at the 2025 results, the sequential acceleration is, it's undeniable.
What are we talking about in terms of numbers?
Okay, so Q1 2025 revenue came in with 16% year-over-year growth.
Which is solid. Not bad at all.
Solid, yeah.
Oh.
But then Q2 really pushed things forward, climbing to a 22.1% year-over-year increase.
Okay, so that jump from 16 to 22% is a strong signal.
It is. It signals good operational work, but the real story, the structural signal, is buried a little deeper in the revenue mix.
Oh, wow.
While the total revenue grew that 22.1%, product sales alone, we're talking the actual hardware, the tech they sell, grew a staggering 37.1% year-over-year in Q2.
Whoa. Okay, that gap is huge. Product sales growth is outpacing overall revenue growth by, nearly 15 percentage points?
Yep.
From an investor's perspective, why is that divergence so critically important?
Because it signifies this profound and very positive shift in their business model.
Okay.
I mean, think about it. Usually when tech companies start out, a lot of their revenue is from services, maybe customization, things that carry, lower margin.
Right, maybe 30 to 40% gross margins in that range.
Exactly. But product sales, especially for proprietary tech like their drone systems, they tend to carry much, much higher margins. We could be talking 50% or more.
So if that 37% product growth rate holds up, it acts as an immediate margin tailwind. It could boost future profitability without them having to cut costs anywhere else.
You've got it. The company is transitioning toward this really scalable, higher margin product-led growth. We are basically witnessing the inflection point.
Where the quality of the revenue starts to improve along with the quantity.
That is the textbook definition of a bullish signal. It strongly suggests they're moving toward sustained gross margin expansion.
It's great to see that kind of operational acceleration, but, high-growth product-led companies are famous for burning through cash.
Mm-hmm.
So let's pivot to their capital structure. How has Draganfly addressed that financing risk that always seems to plague companies at this stage?
They addressed it head-on. They did a very strategic capital raise in 2025.
Okay. How much?
They secured approximately $25 million USD through what's known as a registered direct offering.
Can you just break that down for listeners who aren't deep in capital markets?
Sure. It's basically a private placement of stock made directly to large institutional investors. It lets them avoid the time and complexity of a full public offering. It's just a clean, fast way to raise a lot of capital.
And $25 million. What does that buy them in terms of runway?
Well, given their prior operating expenses, that injection provides a significant war chest. It's huge.
So it takes the pressure off.
It completely removes that immediate need for any kind of emergency financing. It gives management a runway that lasts for multiple quarters.
And that capital isn't just for keeping the lights on, I assume.
Oh, no. It's for fueling R&D to keep their tech edge, and it supports the working capital they need to fulfill those accelerating product orders we just talked about. It's a massive signal of confidence from the institutions that participated.
Confidence is great, but let's talk competitive moats. In a market like drones, which is evolving so fast, how do you stop competitors from just, copying your tech or undercutting you on price? How is Draganfly locking in its position?
Their moat is built less on just pure technology, though that is important, of course.
Right.
It's more about creating critical infrastructure and these really deep partnership integrations.
Okay, give me an example.
The best one is the exclusive manufacturing agreement they have with Valkyrie for drone delivery stations.
Valkyrie. Okay, this is crucial.
It is, because Valkyrie wants to be a key player in the whole autonomous delivery space.
So Draganfly isn't just selling drones. They're weaving themselves into the physical supply chain, the infrastructure of future logistics.
That's it, exactly. They become a critical infrastructure provider. And that Valkyrie deal wasn't just a handshake. It came with an initial $400,000 order for the delivery stations.
So the exclusivity and that initial revenue really cements them in that ecosystem.
It creates massive switching costs for Valkyrie and, by extension, all of its future customers.
And I noticed they're also using strategic financing to deepen these connections. I'm thinking of that $150,000 in vendor financing they gave to a partner, ILS.
Right. ILS is a key logistics and integration partner.
And why does that small financing detail matter so much?
Because vendor financing, giving a partner capital to make a deal happen, it shows the company is using its new, stronger balance sheet as a strategic weapon.
It's more than just a loan.
It's a strategic investment in a long-term relationship. It locks that partner in, guaranteeing them as a customer for development contracts and other services down the line. It just makes their whole ecosystem stickier.
And these integration partnerships, like the one with Autonom, they just reinforce that moat by creating network effects, right?
Precisely. Once a big user integrates Draganfly's platform for a mission-critical application, whether that's logistics or something super specialized like the Autonom integration for route planning,
The cost and the risk of switching to a competitor just skyrockets.
it becomes exponentially higher. They're building barriers to entry through deep integration, not just patent walls.
Okay, before we get to the catalysts, let's inject a dose of reality here. The revenue story is accelerating, the war chest is full, but what information is still missing for an investor to get a truly complete picture of their capital efficiency?
The critical gap is still the detailed, granular balance sheet and the cash flow statement.
Okay.
I mean, we know they raised $25 million, but to really assess how efficiently they're using that capital, how close they're getting to cash flow break even, we need to see their detailed profitability margins and their ongoing cash burn rate.
So great revenue numbers, but we need to validate how efficiently they turn that into actual sustainable free cash flow.
That validation is still pending.
Okay, that frames the risk perfectly.
Yeah.
Strong momentum, but we're waiting on the capital efficiency validation. So let's shift focus to the future. What are the big catalysts that could drive the stock in the next, say, 3 to 12 months?
There are two major near-term catalysts and then one potential game changer.
Again.
The first two are related. The ongoing Valkyrie revenue recognition, so, fulfilling that $400,000 order and getting follow-on orders. And then the Q3 2025 earnings release, which we should see in November.
Q3 earnings, that's the moment of truth.
It is.
The market's going to be focused on one thing, validation. Did that incredible 37.1% product sales growth rate hold up? Did it accelerate? Or was it just a one-time spike?
That single figure will dictate the whole future margin story.
Absolutely. So what's the game changer?
The highest impact catalyst is the one that moves the company completely outside of the commercial drone box, and that's the Autonom integration. This is where the story gets really compelling.
Tell us more about the specifics of that partnership. How does it get Draganfly into defense and humanitarian applications?
The partnership with Autonom is all about using their drone tech for a truly mission-critical application: landmine detection and route planning in post-conflict regions.
So it's not just flying a drone with a camera.
Not at all. The integration uses Draganfly's systems to carry specialized sensors, could be magnetic, could be thermal, to detect hidden ordnance, and then it processes that data with Autonom's AI to create safe pathways.
So it's data synthesis for life-saving infrastructure. It's not just selling hardware.
Exactly. Pilot deployments are scheduled for later in 2025 in real-world environments. If these pilots work, it suggests a multi-million-dollar market expansion. We're talking defense, government, humanitarian contracts.
That's the difference between being a good commercial drone company and being a critical life-saving technology platform.
That's the leap. And the regulatory and reputational tailwinds from that kind of success would be immense.
I can imagine. Being tied to something as high impact as landmine clearance gives you instant credibility.
It could translate into easier procurement approvals in other regulated markets around the world. It provides a massive halo effect.
Okay, but every opportunity has a risk. As we analyze this Autonom upside, we have to look at the downsides. What are the main headwinds that could derail this?
The most immediate one, which we sort of touched on, is customer dependency. Call it revenue concentration risk.
Right.
While that 37% product growth suggests some diversification, the headline deals Valkyrie, Autonom, ILS, They're huge drivers of the speculative valuation.
So if any one of those partnerships stalls or fails,
If Valkyri's market penetration slows or if the autonomous pilot gets terminated, the impact on near-term financials and definitely on stock sentiment could be significant.
now if we challenge that idea that the 37% growth is a good mitigator, couldn't that just be one or two really big non-repeatable contracts that happen to land in Q2,
That is the precise risk.
which would make the underlying repeatable demand look much weaker?
And that's exactly what we need to watch in Q3. The bullish case assumes that product sales growth reflects broad, diversified demand. If Q3 shows that growth rate falling off a cliff, say, back down to 15%, it suggests Q2 was an anomaly.
An anomaly driven by a few big non-repeatable orders.
Right. We need confirmation that their broader customer base is also buying more.
And the second major risk is tied directly to that high-impact autonomous pilot.
That's execution risk. The autonomous landmine detection pilot is incredibly high stakes. It's technically complex. It's in difficult environments.
Operationally difficult, regulatory heavy, even dangerous.
All of the above. And the tech is unproven at that scale. In a real-world, complex, post-conflict region, any technical failure, any logistical nightmare, it could cause that massive speculative upside from the humanitarian story to just, well, evaporate.
So the whole investment thesis really boils down to this. The high growth potential, the exciting market expansion, it's all tied directly to the successful execution of these brand new, high stakes, and unproven partnerships.
It's a classic high-reward scenario built on high execution risk.
So if we connect this back to the bigger picture for our listeners,
Draganfly is definitively in an inflection phase. It's being fueled by that product sales acceleration, and they've mitigated the near-term financing risk with that $25 million raise.
okay.
So for you, the listener, the critical question is whether management can successfully transition from, promising deals and pilot announcements into sustained, scalable, high-margin revenue.
And that all hinges on Valkyrie and autonomous.
It hinges on converting the Valkyrie infrastructure and the success of the autonomous platform.
Thinking about an investment horizon then, is this a swing trade for Q3 earnings validation, or is it a multi-year hold based on these big partnerships scaling up?
It really offers a clear path for both types of investors.
How so?
Well, a tactical trade into Q3 earnings is justifiable if you think that product sales growth will be validated or even accelerate. That confirmation alone would likely lead to a market re-rating.
But the real upside is longer term.
The true leverage is a multi-year view, yes. If you are betting on the long-term success of autonomous defining a whole new vertical, and Valkyrie establishing Draganfly as critical infrastructure, you're looking at a multi-year hold based on them becoming a sector leader.
That segmentation makes a lot of sense.
Yeah.
So here's our final provocative thought for you to consider.
Don't let the overall revenue number distract you.
Right.
Watch that product sales growth figure, like a hawk. If it accelerates again in Q3, the market will almost certainly reassess the valuation significantly upward.
Which would make the execution risks with the autonomous pilots far less critical for the short-term thesis.
Because that shift in margin profile is the most tangible path to profitability.
That's all the time we have for today's analysis. If you enjoyed our conversation on Draganfly, make sure you hit subscribe for more smart wealth analysis.